What's up, YouTube? Silver Dragons here, and in this video I'll be talking with Lior Gantz, the founder of Wealth Research Group. We're going to be talking about precious metals in 2020, everything that's gone on and what we can expect moving forward. So Lior, welcome.
Thank you for having me.
Absolutely. And for everyone out there listening, I'll put a link down in the description, but he's got an awesome PDF file here on wealthresearchgroup.com/gold playbook. So it'll be a link in the description. Definitely check it out. I'm looking at it right now on my computer. The quintessential gold and silver stock playbook. So he talks mining stocks and physical and lots of cool stuff. So thanks for putting that together, Lior.
No problem. I think it's very timely with everything that's going on. Obviously, gold at an all-time high.
Yeah, absolutely. So I wanted to start off with talking about something that people may or may not be aware of, but it's this idea of silver's inverse correlation to the dollar. You know, what are your thoughts on that? Do you think it's really the main catalyst for this run-up we've seen?
Yeah, so silver and gold throughout history, they trade in a ratio that's very traditional. It's been either 16 to 1 or 12 to 1, and they have the same utility. In modern, not in modern history, but in ancient history, as barter and trade, etc. In the 20th century, that has all changed. And in 1944, when the current monetary system was started in the Bretton Woods agreements, the dollar was pegged to gold. In other words, $35 were 1 ounce of gold. And everyone was working with the dollar since they knew that they can always redeem $35 to 1 ounce of gold. That went on for about 25 years until 1968, when the French really doubted that America had enough gold to cover a 35 to 1 ratio. They saw the Vietnam War, they saw the Korean Wars. They were just after an audit. They were like, I want to know that for every $35 out there in circulation, there's an ounce of gold in your reserves. And they were really pounding the table on this. And Kissinger, who was very much influential back then to President Nixon, he was like, if they audit us, that's going to be a problem. So what we'll do is we'll just stop the convertibility of dollar and gold. And you saw what happened in the 1970s. Gold went from 35 an ounce to 850 an ounce. That's a 2,400% return. And silver did something even more amazing. It went from $1.92 to 50 in one decade. That was a dollar weakness. That was an official debasement of the dollar. And so the Federal Reserve had to raise rates to almost 20% in order to stop that. And then we saw the 80s and 90s come along. In 2000, right after the 9/11 attacks, the dollar started another bear market. And for 10 years, you saw gold going from 250 an ounce to 1,900 an ounce in September of 2011, and silver going much higher than that in terms of percentage gains, and ending up around that $50 an ounce mark in 2011. But from 2011 onwards and up until March of 2020, up until this coronavirus panic in 2020, the dollar has been in a bull market. And so you've seen a very poor performance dollar-wise from silver. Now, in other currencies, in other fiat currencies, gold is at an all-time high in over 80 fiat currencies around the world.
Wow.
And so, so it's important for people to understand that in dollar terms, that's one way to talk about gold and silver, but in other fiat currencies, they have been depreciating at a fast rate in the past decade, while the dollar, because of interest rates and arbitrage, because the US dollar has a higher interest rate than the Japanese yen and then the European Union, then the dollar's been a bull market. But right now that has changed. In the last 3 months, that has really changed. And you saw what is happening with silver. It's absolutely, it's been the best performer in the past 120 days. Its July month was the best month for silver since the Hunt brothers. And within July, it had a week where it was the best week of its performance ever. So definitely an inverse correlation with the dollar that is right now at a 2-year low. And the way we see it at Wealth Research Group, and we wrote a lot about it at wealthresearchgroup.com/ratio and /rally, that's all about the fact that the dollar's days as a reserve currency are numbered, and that's a huge detriment to the way of life of Americans.
Yeah, I think that if we did see the end of the dollar, I mean, that would have implications worldwide. It would be something crazy to be living through. I don't personally know if that'll happen in my lifetime or when that would eventually happen, but I feel like it would be good news for people that are holding gold and silver, but bad news for everyone who isn't. So one thing that you brought up was, the Hunt brothers, and back in the 80s when there was that crazy run up on silver. And I think what a lot of people maybe don't understand was at that time, the run up on silver to $50 an ounce, with inflation since then was actually much higher. It was over $100 an ounce. If we look at today's dollar, but regardless, that was mostly based on the demand for silver, right? It wasn't necessarily inflation, but what's happening now absolutely could be because of inflation, right? We've seen the national debt grow quite a bit just over the last 3 months as we've seen silver run up, but also I think demand plays a part in it as well. So do you think it's mostly inflation based, or more just demand and people with the flight to safety mentality?
That's a great question. So silver, because it's so dirt cheap, it's a byproduct in mining. Most mines are not pure silver mines. Entrepreneurs do not go out and try to find silver mines. They find gold mines, zinc mines, lead mines, copper mines, and there's silver in there. There's a silver component. It's so cheap that it's not economical throughout the globe to try and go for silver directly. With that said, 50% of the usages of silver, or the demand, is industrialized. In other words, there are thousands of industrial uses for silver, and that is a product or a consequence of the fact that it's been so suppressed in price throughout the 20th century and the later stages of the 20th century, that they started saying, hey, I can use a bit of it here, a bit of it there in all kinds of industrial components. Now, 19% is bullion. And the bullion part, or the people that are looking for an inflation hedge, the retail people, that's a very small market for silver. Yet this is what is driving up the price. In other words, the industrial companies obviously want to pay as little as possible. The miners want to mine it for as low as possible. So because it's a commodity. So what is driving the price up? Who is pushing the price up? It's the guy who's at home now, and he understands that there's an inflationary problem. He looks at gold, he sees that 1 ounce costs $2,000, and hey, there's silver, it has exactly the same components and utility as money. Why do I not buy silver if it's almost 100 times cheaper? And so once he's in his car and he goes to his nearest bullion dealer, or he goes online, if he has to buy 5 or 6 ounces, which is what the normal person buys, or 7 ounces or 10 ounces or around, right? It doesn't really matter to him if it's $30, $40, or $50. The difference, and ultimately for him, would be $100. If he's already made the decision that there's a huge problem with the dollar, like you said, something that is going to be detrimental and huge, to lose the reserve currency or to shake up the reserve currency status. If he's already decided to spend $150 on silver, if it ends up costing him $250, it's not a deal breaker, and that's why silver has a lot of potential to move higher because of inflationary expectations. Because, as you said, the U.S. government has changed, I believe, 4 times the way it looks at inflation since the 80s. So yeah, if you look at inflation adjusted, the way they measure it back then, silver's price in $50 worth of silver in 1980 is $600 in today's dollars. Wow. So there's a huge upside in terms of inflation adjusted, huge upside. Nominally, it's 60% below or 40% below its all-time high. So just on that nominal price alone, there's a big upside compared to gold, where it's already trading at an all-time high. So you have that industrial demand that's pushing it lower, making it more like a commodity, less a precious metal. But then you have those bullion crowd, the people that want to buy it the same way that they buy gold, but it's much cheaper, and so they do that. And for them, that difference is not that big of a deal. If you want to buy 5 ounces and they cost $40, that's $200. If you want to buy 5 ounces and they cost $60, that's $300. You're going to do that purchase anyways. And that's why I'm saying it has a lot of potential because of inflationary expectations. And what those are is, when the coronavirus happened in March, predominantly March, April, prices plummeted. And so just like in 2009, when you saw that implosion in prices and there's 10% or 20% or 30% unemployment out there, the expectation of the average person is, of course, prices are going to be higher next year. And that expectation is what usually drives inflation higher. It's not the actual inflation, it's the expectation which drives people to take some action a year before they actually see the inflation happening. And that's what I think is happening right now.
Yeah, I was looking at different predictions for expansion of the money supply, more U.S. national debt, and one of the things that I noticed, which was very intriguing to me. So I was born in the early 90s. I was born in 91, and the U.S. national debt was right around $3 trillion, give or take, at that time. And now today, we're looking at around $26 trillion for the U.S. national debt. But some of the predictions moving out into like 2028, they're looking at almost $80 trillion in U.S. national debt. So that's massive, just in less than a decade, right? So if we're gonna see that much of debt increased in less than 10 years. I mean, who knows how high gold and silver could go? I mean, I feel like you are right. Yeah, absolutely. It's not necessarily the inflation happening right away, but people's expectation for the future. So how long do you think this bull run will continue for gold and silver? Do you feel like in 2021 it will slow down, or could this go for a decade and beyond?
Well, excellent question. You brought up 4 things also in the question that I want to address. You said 1991, $3 trillion was the national debt. Just in 2020 alone, we've increased the national debt by over $3 trillion. So it's unbelievable what is happening right now. And also with what we call debt to GDP. In other words, look, a company like Apple, for example, it can have billions of dollars worth of debt because they can service them. And that's called the service ratio. In other words, if you make a lot of money, you can also borrow a lot of money. The United States government doesn't make a lot of money in order to borrow as much as it does. The only way that it can do that with tax revenues is because interest rates are zero. If interest rates were not zero, this would be a huge problem to service this kind of debt. Secondly, with 26 trillion in mind, this is without unfunded liabilities. In other words, if you look at what the Medicare, Medicaid, and Social Security obligations that the U.S. government has promised, the 78 million retirees that are out there, and every 10 seconds as we're doing this interview, count every 10 seconds there's another baby boomer that's reaching the retirement age and going on entitlements, that is unsustainable. So yeah, it is obviously an unsustainable thing. Gold and silver, though, do not correlate with the national debt as much as they do with what we call real negative rates. And what is real negative rates? The measuring stick for all asset prices around the world is the 10-year Treasury bond yield. Whatever the government of the United States offers its lenders for 10 years is the measuring stick. In the 80s, you could have received from the U.S. government every year more than 10% interest for lending in money. That's a massive return, In the 90s, it fell to 8%, but still, if you can earn 8% and Washington pays you that interest, many people that could save, right? If you have $1 million, you put 8%, that's $80K a year. You can retire on that. In the 2000s, it went to 4%, and in the 2010s, so the decade we just finished, it went to 1.5% to 2%. That's a massive reduction in your savings power when you want to retire. And so when you have that, and then you have about a 1.5 to 2% inflation rate, in real terms, if you get a 2% interest and then there's a 2% inflation, you're earning zero. Those are called zero real rates. Right now, they're negative. In other words, the 10-year bond yields 0.6%. So if you have $1 million, the U.S. government is willing to pay you $6,000 a year for it. That's what they're willing to pay you in interest, to borrow that $1 million from you. And then you have inflation at 1.5%, you're actually losing 1%. No one can save money in this kind of environment, and that's why they're moving into a cash alternative, which is gold and silver. So that's the main reason why gold and silver are so important right now in someone's portfolio, because you're actually losing money in bonds and in cash. You're losing purchasing power. If you put $100 bill in your pocket in 1971, that dollar is worth about, that $100 bill buys you about $6 worth today. That same $100 bill. And flip that equation around. If you took that $100 in 1971 and bought 3 ounces of gold back then, today you would have $6,000 worth of purchasing power, because that's $2,000 times 3. It's an incredible difference over a lifetime, and that's why inflation is very much equivalent to how they cook frogs. You cook a frog when it's still alive. You put it into that pen, and then you start boiling the water. It doesn't sense it at first. It doesn't understand what's going on. The water starts to heat up, then it gets to a boiling point, and he can't help it anymore. And that's the way inflation works on somebody's life over a lifetime. That's why gold and silver are so important, especially when you have real negative rates, which we have right now. And then you ask me if it's going to last. Well, in 2018, we got the answer to that. They tried to raise rates. They tried to normalize rates in 2018. And in December 2018, when they raised rates to 2.5%, the stock market rejected it. And it went down by 20% in 1 month, the worst December since the Great Depression. The reason is that corporations have borrowed so much money at 0 interest rate and at 1%, and so many homeowners have their mortgages tied to 1% and 2% and 3%. They cannot exist in a world where rates are higher or normalized. And so the Fed has already said, we do not intend to raise rates for years. And so if you have that environment coupled with a rising inflationary tide, that's getting into -2 and -3% in terms of interest rates, and gold and silver can be worth much more. You asked the question, how much can gold be worth? It currently covers about 6% of the dollar currency supply. In a classical gold standard, it covers 20%. So that's implied at $6,000 an ounce. That's 300% more than it is right now. At a very rough gold standard of 40%, which we had in the 20th century, that's 6 times today's dollars, and that's $12,000 an ounce. And if you want to cover the entire currency supply, which happened in 1980 for a few weeks when gold was trading at $850 an ounce, if you want to do that today, gold needs to be worth $32,000 an ounce to cover all of the currency supply and go back on a full gold standard, which it will never do. But it just to show you how incredible the opportunity with holding gold over owning just cash. I'm not comparing gold to owning real estate or to owning stocks, etc. I'm saying, look, if you have savings Why are you going to put them in cash? What is the incentive of doing that? There is none.
Yeah, I absolutely agree. I mean, that's something I talk about constantly in my channel. Why do you have, numbers on a screen in your bank? It's not doing anything for you. You're losing purchasing power, but obviously you're missing opportunities as well. And it's also very interesting that you pointed out that the interest rates are basically negative because of inflation. That's something I haven't really thought about. But yeah, and they've said the rates will be zero or effectively zero till at least 2022, I believe. So yeah, absolutely, you should be putting your money in gold and silver. Now, one
If I
thing
may say one
go
more
ahead.
thing about this, the central banks in Europe and in Japan have been on negative rates, official negative rates, for a few years. So just to give you an idea of what I'm saying, the Federal Reserve has not lowered real rates or the Fed's fund rate to negative. In Europe, they've done that. They've actually said, we are, right now, if you want to lend us money, we'll pay you back less than you gave us. You want to lend us $1 million? At the end of the term, you'll get less than $1 million back. Not only will we not pay you interest, you will pay us the interest.
Yeah.
That is the reason that people own gold and silver today.
Yeah, that's just so ridiculous to
I
me
know.
that people would be would be lending the government money at that point. Okay, so we've talked about 2020, we've talked about potentials and whatnot. One of the last things I wanted to get your opinion on, Lior, is Warren Buffett. Obviously, it's something really big going on in the news. I think he bought somewhere in the neighborhood of over $500 million of Barrick Gold Stock. What do you think is going on there? Does he see something that other people don't see? I mean, is this a sign that gold's going to go even higher?
That's a phenomenal question. And I'll tell you what, in 2016, when I launched Wealth Research Group, I started also covering mining shares. And we still do until this day. Like literally in 2020, we've covered a few mining shares that have already doubled or more in our free newsletter. And in 2016, we covered one of them that is called First Majestic Silver. If I'm not mistaken, you've spoken with the CEO and founder of that company. And for example, that company went up 800% in 2016. Reason being that, or 600% in 2016. The reason is that it did that in such a short time span, in about 6 to 8 months, is because some central banks, the Swiss central banks and the Danish central bank, bought shares of that company. In other words, a large institution, a very reputable institution, started to buy mining shares, and other people followed suit because they realized this is huge. This is the same effect that Warren Buffett will have on mining shares. Now, in my opinion, it was not Warren Buffett himself that made that decision. He has two fund managers, Ted and Todd, and I believe that one of them would be the person that was in charge of that. But obviously CNBC and other outlets will ask him that question outright in the next few days, I am sure. Regardless, he bought about $500 million worth of Barrick Gold Stock, Barrick Gold being the largest gold-focused mine in the world. The way that this sector works, the mining sector works, you have these very few companies that are $1 billion plus, and they operate the largest mines. Then you have a mid-tier group that either operate small mines or are developing and are not currently mining, but are developing huge mines, and the big ones will want to buy them out. And then you have really small companies that are just starting to get stuff across and are looking to either explore for gold, or they found it and now they need to make sure that it's economical. At $2,000 an ounce, there are many companies that have economical projects. At $29 an ounce silver, there are many companies that have economical silver deposits, because most gold deposits are economical at $1,000 to $1,200 an ounce. So at $2,000, they're making a fortune. Silver, most companies are looking to mine for $13 to $14 an ounce, so they're making 100% margin right now on silver, and therefore the end result is that this industry is one of the strongest industries out there right now, especially with what you're seeing, because obviously coronavirus is hurting the real economy. It's hurting the consumer. It's hurting a lot of things. It's not hurting gold or silver. And these mines are working and operational. So Buffett getting into Barrick Gold is a big deal, just like Buffett buying silver in 1998 was a pivotal moment for silver because it actually started to rally a year after. Then Bill Gates came in and bought shares of one of the earliest silver miners, and in the year 2000, and that thing boomed. So if you're asking me, that is like a starting gun. That brings a lot of institutional investors and a lot of fund managers to the picture, saying, if he saw something, I need to take a second look.
Yeah, so it seems like there's not only potential for physical gold and silver, as we've discussed, lots of potential, but also in mining stocks as well. So what would your suggestion be for people to go after both or one or the other, more heavily on physical or stocks? What's your opinion on that?
Yeah, so, okay. So with gold, what I've personally done is I've taken 2 years worth of expenses. In other words, I looked at how much my family spends in 1 month, and I multiplied that by 24, so that's 24 months, and I converted that savings in cash to physical gold and physical silver, 50-50 in terms of dollar volume. In other words, if my family spends $10,000 a month, you multiply that by 24, that's $250,000. You split that in half and you buy 125,000 in silver coins and 125,000 in gold coins. In theory, this covers you if there's a 2-year depression, if there's something that kills your career, kills your income, if you're out, and if this becomes like the Great Depression of the 1930s. So you have that stashed, and it's just sitting there, and it's purchasing power that's actually increasing every year. On top of that, I look at ways that I can capitalize on what's happening right now with mining shares. So yeah, what I do personally is I actually speak with CEOs of companies, and I actually look at individual companies. But obviously there are ETFs out there for people that are part-time and have, not the inclination, the willingness, the capability, the time, or whatever. They just want to buy a basket of great miners. There are ETFs out there that are just for that, and they're actually mentioned in the wealthresearcher.com /gold playbook that I prepared for your listeners. And what we do with our newsletters, we also cover individual companies, individual stocks, companies that, for example, we covered one here in 2020 that went from 28 cents to over $3 just in 2020 alone. So obviously there's a lot of potential if you find the right ones, and if you find them undervalued. But and I do think there's a lot of leverage in the mining sector compared with the spot price. For example, if gold goes from 2,000 to 2,500, you'll make a 25% return. But if gold goes from 2,000 to 2,500 for a mining company, their margins go from 60% to 150%. Their margins go up 300%. And that plays a huge role in driving that share price much higher. So a great gold company or a great silver company is almost like a leverage on the price of the spot commodity.
Right, absolutely. Well, I do want to say thank you so much, Lior Gantz, for all of the valuable information you provided. And once again, for anyone listening, go ahead and check the first link in the description, wealthresearchgroup.com /gold playbook. It's the quintessential gold and silver stock playbook. Also lots of information on physical gold and silver as well. So thank you again so much, Lior, for coming on. I really appreciate it.
Thank you for the opportunity.